Welcome to Finance Deep Dive. There's a massive $38 trillion question hanging over the U.S. economy. And in this video, we're going to break down the answer, and more importantly, how this colossal national debt is going to directly affect your wallet by 2026. Okay, let's just jump right in with a headline number. And wow, as of early 2026, the U.S. national debt has absolutely ballooned to $38.43 trillion. I mean, it's a number so huge it's hard to even wrap your head around, but its impact is about to get very, very real for all of us. And to put that in perspective, get this. The debt is growing by over $8 billion every single day. That's about $334 million every hour. The speed at which this thing is climbing is a huge part of the story.
So what does that actually mean for you and me? Well, if we were to divide that entire debt pile among every single household in America, it comes out to over $285,000 each. Now, don't worry, you're not going to get a bill in the mail for that amount, but that burden, it shapes the entire economy we all live in.
So how on earth did we get here? And what exactly is inside this staggering number? Let's take a closer look at the anatomy of this $38 trillion problem. Okay, take a look at this. What you're seeing here really shows the acceleration. On the left, you can see those daily spikes. They're getting bigger and they're happening more often. And then on the right, you can see the annual increases just show this relentless climb with that huge jump back in 2020 and really big additions ever since.
You know, this debt isn't just one giant pile of IOUs. It's really split into two main buckets. About 80% of it is debt held by the public. You can think of this as what's owed to investors, companies, even other countries. The other 20% or so is intragovernmental debt, which is basically money the government owes itself, like moving funds from one piggy bank, say Social Security, to another.
But here's the thing. The sheer size of the debt is really only half the story. The real challenge that's popping up right now is the exploding cost of just paying the interest on it. And this is a massive milestone. For the very first time, the annual interest payments on our national debt are projected to hit $1 trillion in 2026. That's $1 trillion that isn't going to services or new roads, but just to cover interest. So to really get the full picture of the debt's impact, we have to look at the economic world it's living in. Let's see what the forecasters are saying is coming in 2026. Check this out. We've got predictions from three of the heavy hitters: the Congressional Budget Office, the Federal Reserve, and the Office of Management and Budget. And, well, they don't exactly agree. They all have different takes on how much the economy will grow, what unemployment will look like, and even inflation. That PCE column there, that's just a way they track price changes. This kind of uncertainty, it just makes planning for the future that much harder. Now, a huge piece of this puzzle is a landmark law that was passed back in 2025. You might have heard about it? Yep, it's actually called the One Big Beautiful Bill Act. This sprawling law, we'll just call it OBBBA for short, completely reshaped huge parts of federal tax and spending policy, and we're really starting to see its effects now. So what did this thing actually do? Well, it made those 2017 individual tax cuts permanent. It also pumped a lot more money into defense and border security. Now, to try and balance that, it made cuts in other areas like Medicaid. But even with those cuts, the net result is still a projected jump in the deficit of almost $3 trillion over the next decade. And this chart right here, it just lays it all out, plain and simple. Before OBBBA, public debt was on track to hit 117% of our entire economy, the GDP, by 2034. But after OBBBA, that projection jumps up to 124%. That's a new record high. All right, let's bring this all the way down to your bottom line. How does all this macro stuff actually translate into what you're going to pay in taxes for 2026?
So here they are, the official federal income tax brackets for 2026. Thanks to that OBBBA law we just talked about, this 7-bracket system is now permanent, and the income levels get adjusted for inflation every year. You can see the top marginal rate is still hanging out at 37% for the highest earners.
Now, it's not all bad news for your taxes. For a lot of people, there's a bit of a silver lining. The standard deduction, the amount you can just automatically subtract from your income, it's getting another little bump for inflation. It's going up by $350 for single filers and $700 for married couples filing together.
And for all the parents out there, OBB also made the increased child tax credit permanent. For 2026, it's going to be $2,200 for each kid, and now it's also going to be adjusted for inflation every year going forward. But the impact on your wallet goes way beyond just your tax return, right?
all of this massive federal borrowing, it puts upward pressure on interest rates pretty much everywhere else in the economy.
So if you're thinking about buying a house, yeah, those super low mortgage rates we saw a few years back, they're probably not coming back anytime soon. See, to get people to buy its debt, the government has to offer higher interest rates on its bonds, and that just pushes up borrowing costs for everybody. The result is that experts expect mortgage rates to just kind of hang out around 6% in 2026.
And it's pretty much the same story if you're in the market for a new car. While the forecasts do show a little dip from 7% down to 6.4% in 2026, those rates are still pretty high historically, making it more expensive to finance a vehicle.
And that little rate cut we just saw, what does that really mean for your monthly payment? Well, for an average new car loan, it works out to a savings of just $11 a month. It's a perfect example of how even when rates fall a little, the new normal is still just more expensive.
And that really brings us to the final and maybe the most important question of all. When we're spending $1 trillion a year just on interest, that's more than the entire defense budget. What else gets squeezed out? What important investments in our future are we trading away just to service the debt from our past?
You know, grappling with numbers this huge can feel a little overwhelming, but breaking them down like this is the first step toward really understanding the challenge we're facing. If you like the content, don't forget to subscribe to Finance Deep Dive. It motivates us to keep posting.